Hello everyone, and welcome back to the Redhedge Podcast. Today I'm here with Michael John Lytle, the CEO at Tabula Asset Management. Hi Michael, and thank you for taking the time to come in here.
Such a pleasure, Andrea. Thank you for having me.
So tell us about Tabula to start, and then we take it from there.
So Tabula is an asset manager. We've existed for a few years. We're focused mainly on fixed income, particularly ETFs. We have a sister company, Tabula Capital, which is a hedge fund. We have been looking at what is the differentiating characteristics of a fixed income ETF that makes it more valuable than the current offering. So people ask me, how do you break into the asset management space, particularly the ETF space? It's very crowded. It seems like everything is commoditized. How do you differentiate? So my answer is you have to identify a value proposition, something that other people are just not doing for whatever reason. And one of the things that I've always noticed around fixed income is that it's got a second-class status in the ETF space. So I was at Morgan Stanley for 18 years, most of it in fixed income. I always felt fixed income versus equity got a raw deal. If you go to the back pages of the FT, there'd be 1 page on fixed income and 7 on equities. If you went to a dinner party and you said, I do bonds, they go, what's that? How does that work? You tell them you work for some company, do equities. They're like, oh, I get it. Yeah, I bought that, right? And I thought that the OTC illiquid nature of fixed income also further distanced people from the instruments because, there are like 70,000 listed equities in the world and there are 5 million fixed income securities. So it's just an absolutely enormous number of securities. So you can't identify with an individual security. Perhaps you can understand an asset class. Maybe you'll understand some of the issuers. Maybe you won't understand others. So I think we have a number of problems in the fixed income space, kind of getting people to understand what is it, what's the value proposition, why would I buy bonds if all I know is equities? What are the situations in which there's value in the bond space, specifically because of the characteristics, the place in the balance sheet, that you come before equities, for example, in the waterfall, things like that. So at Tabula, we kind of said, well, look, fixed income, it came later to ETFs than equity did. When you put in a ticker in Bloomberg, you write the ticker and you write equity go. And so it's kind of counterintuitive that it's fixed income. It actually causes problems with insurance companies because they categorize ETFs funds as equity. And so they hold capital against it at an equity level rather than a fixed income. So that can hurt you. But then the question was, well, what's the opportunity? How could you add more value to fixed income or to fixed income investors in an ETF wrapper, right? So in equity, it's all about the liquidity of the underlying assets feed through into the liquidity of the ETFs. And it's all the thing about it's as liquid as the underlying. In the fixed income space, if you say to someone, it's as liquid as the underlying, they're like, oh, that's terrible, right? Because the underlying is not liquid. I don't understand how it works. So the opportunity is actually to create an instrument that provides liquidity that doesn't necessarily exist to you as an investor when you look at fixed income. So as we set up Tabula, we were saying, okay, if we're going to do things in the fixed income space, can we do things that are not just copies of how people go about indexing equity and say, okay, we'll do the same for fixed income? What's the differentiated opportunity? And that also makes us relevant to large investors. So the problem you have as a small manager is lots of competition, lots of commoditization. So why should we take the time to interact with you? And so we've always had to come up with new funds that do something different, offer a new slice of exposure to clients.
That's very interesting. I remember at the beginning of your journey as Tabula, you were offering almost a solution to smaller asset managers or smaller investors with the protection ETF, with the one long crossover ETF. And I love that because at the beginning of my career, I was working for a family office which was unsophisticated. And all I was trying to do is to get an ISDA to actually buy CDS or index CDS or anything that could create complexity within the strategy, and there was no solution. And when I seen it, that was possible to have an ETF to basically be long crossover was fantastic. But obviously, I guess there was a challenge there because the level of complexity of the product is quite high compared to the classic fixed income bond buyer, which doesn't have an ISDA line, cannot understand it. Was it a challenge for you guys at the beginning of that?
An educational challenge.
Yeah.
So basically what you're doing is you're taking a product that only hundreds of institutional investors ever use because they have to have ISDAs, and there are a limited number of institutions for which it's worth the time to get an ISDA, and then trying to democratize access to that. If you're trying to do it by yourself, it's pretty difficult, right, as a small institution. I think what we learned through the initial iteration was the two-way conversation with institutions. Here, we're doing this. Here's our idea of adding value. They'd say, well, that's interesting. Intellectually, we like it. However, from a practical perspective, where we have cash that needs to be invested from a multi-asset perspective, these are the problems. These are the gaps in the portfolio that need to be filled. You're kind of creating something new that maybe it will become a gap in the future, but not such a gap right now. And I think one of the things about CDS is it's incredibly liquid, right? It's the most liquid part of the fixed income credit space, but nobody understands it, right? There's like 80 billion of turnover in broadly CDS indices, but yet most people don't even know what I'm talking about when I start the conversation. And so I think it was a great product to demonstrate what could be done, but it ultimately led us to other solutions that kind of hit a broader swath of investors' problems that they had today rather than tomorrow.
Interesting. And I do agree. CDS are perfect, but difficult to sell in a way.
Well, and our sister hedge fund is making amazing products using CDS, doing very levered CDS positions, using credit options to hedge against downside risk, all the stuff that you would do if you really understood the space. But putting it into a UCITS fund, selling it broadly, trading it on exchange, a little bit more difficult.
Indeed. I mean, and then you evolved into the ESG space as a specialization. I know because we actually use your product. We do a Redhedge is relative value, and one of the big theme is to understand and kind of picking who is deteriorating in the ESG score. So kind of negative selection or positive selection. So we were using one of your ETF as an index and picking the companies we would believe were less good on the ESG side. So we have, and one of the reasons why I decided to utilize the ETF is because it's actually the whole provider was smaller than the BlackRock, and smaller is better because in 2020, everyone was completely shocked by the NAV premium move of the IG ETF of the bigger provider. And I remember monitoring your products at the time. You were much more resilient on that sense because I guess a smaller size overall can be sold with much less bid offer or liquid. The liquidity is there when if you have to sell 10 billion, it is very, very difficult, right?
Yeah.
So I did feel comfortable in having a smaller provider to the big one I referred to, and that's why we selected you as a not only as because of how well you were tracking the index, but as well as the tailed risk of the NAV premium, which we try to hedge anyhow, and it's more sensible. Do you think other people will look at this angle?
Yeah, look, I think you touched on two really important parts. Well, the first about ESG, I think the biggest problem in creating ESG-linked products was what problem are you solving for? I think 4 years ago, people were putting these broad kind of ESG screens against things with no particular investment logic around why would someone buy this? It was more like cleaning up a basket, right? And so we got focused on Paris-aligned investing because that actually has a value proposition. It says, the economy is changing, it's heading in a certain direction. If you get your portfolios ahead of that change, ultimately it'll reduce volatility, possibly knock out some credit exposure to a changing economy, and give people a way to express their views in fixed income. They know how to do it in equity, but they're not quite sure how to do it in fixed income. So we did a number of Paris-aligned strategies from European IG, European high yield, fallen angels, and also a ultra-short product, which is kind of like less than 1 year liquid solution. The second part of what you're talking about, which is when you start to build index tracking products that use bonds as their underlying, there can be some unintended consequences. And there are also some issues around the data that's available for the indices versus where stuff actually trades. So during the pandemic, one of the issues was when an ETF and its basket start to perform differently from where the index says it should be, which one's wrong, right? And what we discovered was that the indices, the places where they get the data from, is often a bit stale or matrix priced. And when you compare it to the pricing, particularly of a smaller provider who's very focused on each individual bond that's in their portfolio and getting everything exactly right, you find that the ETF is actually a better indicator of where that basket is trading right now. And so the journalists would ask you, they'd say, oh, you're trading away from the index, what's wrong, right? And you say, well, no, actually, you have to look at the indices and question, are these really using the right data source? Now, when you do an equity index and you're using a series of equities, there's only one per company. They're traded on one exchange. You're getting a snap at the end of the day. There's usually an auction at the end of the day. There's something really driving the prices to be accurate to that security. None of that exists in fixed income. They're not traded on exchange. There is no end-of-day auction. Let's take the U.S. Treasuries off the table. You really have some problems with knowing what the right price is. So as a manager, what we're partially doing for investors is giving them confidence in the selection of which fixed income securities we're using. And, when you start with a fixed income index, you start with thousands of bonds that could be in there, and then you narrow it down. You can use Paris-aligned strategies to narrow it down, or you can just use ideas of what's actually the liquid securities. The criteria that people use to determine what is a liquid fixed income security can be pretty skewed, because people will use just market cap weighting. They'll say, oh, there's 500 million outstanding of that bond, it must be liquid. Well, I worked at Morgan Stanley for 18 years. I worked on the private placement desk. I would do private placements of 500 million. I'd sell it to two investors. Is that a liquid bond because it's big? No. It just was a name people were looking for at the right spread. I did a deal, sold it to two different insurance companies. It's gone forever, right? On the other hand, there may be an equivalent size transaction that trades all the time. And you can go and talk to the trading desk. You can see that there's turnover. You can go talk to the OTC providers like TradeWeb and Market Access and so on and see the actual activity. But Europe doesn't have the equivalent of the TRACE system in the US that actually tracks the activity in fixed income securities. So we're a little bit blind half the time as to where the actual trading activity is going on. Also, I had assumed, because I ran electronic trading for Morgan Stanley in fixed income back in the early 2000s, that I was the last person who would be bothered with individual bonds, right? I figured this thing was going by the way of the dodo. Soon everything would be traded electronically. The traders wanted to stop trading cash and wanted to start just trading CDS. And I said, wait, you can't do that. You can't price CDS if the bonds don't trade, right? The CDS is there as a default option into bonds. If the bonds aren't there, we got nothing, right? But I did assume that because we were moving so much of our trading into electronic venues, we were doing a lot across Bloomberg, we were selling stuff, all the sort of middle market activity was electronic, that by 20 years later, there really wouldn't be any bespoke, artisanal bond distribution through salespeople. It's gone the other way. I was talking to a friend the other day. He's got a 25-year-old son who just started on a desk trading Eurobonds and distributing Eurobonds. I'm like, you got to be kidding me. I thought that no young person would take that job because it was just a path into a dead end, right? So it's very clear that we haven't solved the basic questions around how do you make a more efficient distribution and trading environment for cash bonds, because we continue to do the same things now that we were doing 25 years ago that it looked like technology was going to totally rewrite. So
it is, who is not familiar with the fixed income cannot understand how opaque is that market itself. In a way, it is liquid because it is liquid. And the main difference between US and Europe is the data point with the indications, which makes the index price in the end are a lot more than in the US. But because, as you mentioned, Trace is there, so you can actually see where something is traded in the US, you have a much clearer idea where the securities are clearing in the US, which you have not in Europe. That's why in COVID the NAV premium moves so much, is where actually things are trading versus what they're supposed to, given the index which we were referring before. And that is why, and again, of course, the numbers of security compared to the numbers of human being that can be in a bank trading is just too much. The balance sheets are not big enough. There is many reasons why this almost technological revolution didn't kick in yet. And even here, even 1 million most likely will be traded over the phone. Still, we do literally pick up the phone, call a bank, sell a bond, rather than sending down. I mean, it has improved. Portfolio trading and ETF providers and ETF liquidity providers make this market a bit better, and for us a bit more inefficient, because if you wish, if an ETF has inflows, they technically buy the same lines because it's just easier, and make those lines mispriced. We look at relative value, so they will be more expensive every time there is an inflow and more cheaper every time there is an outflow, and so we need to weight it in and model it. But
I think you're getting at a number of different things. One is when we issue a bond, we don't issue it to be liquid, right? We issue it to get investors to give cash to the company so that the investors get a yield, the company gets funding, right? No one in that transaction is looking for liquidity, right? The investors are buying a 5-year bond because they want it to be 5 years. If they don't want it to be 5 years, they buy the 3-year, right? So that is not a liquidity creating situation. So, if you take the old Eurobond, in the 90s, which you'd issue, GM would issue a 5-year Eurobond with an annual coupon in Swiss franc. The investor would come along, buy that bond, put it in their safe deposit box in Switzerland, go back to the US, come back for their ski trip the next year, clip the coupon, take the coupon down to the bank, get some cash, spend that cash on their ski trip, no problem with taxes, no problem with cash, move on, right? That's a market that doesn't look for liquidity. It's a market that solves a cash flow problem for the individual. The flip side is when you start to think about how does indexation work? How do you create liquidity? If you want an instrument to truly be liquid, what drives that? We've seen in the CDS space how the interaction between large investment banks and a series of institutional investors who have fundamental issues around credit, either wanting to buy protection against existing positions or sell protection to get a yield which is akin to having bought a bond, can work and become very liquid, particularly when you narrow down the list of names. If you look at something like IEAC, right, BlackRock's European IG product, which has been around for over 20 years, is coming up on 20 billion euros in notional. It's by far the largest ETF in the fixed income space. It's more than double most of the other products, even bigger than the treasury products, which doesn't make a whole lot of sense if you think that it's about asset gathering. But if you realize that what it is it's actually partially an asset gathering tool, maybe let's call half the AUM asset gathering, the other half of it is actually a trading tool. Because there's nothing else out there which allows you to trade a basket of fixed income securities in a liquid manner with a tight bid offer, with known delivery, with on-exchange prices. So now you've solved a totally different problem, right? You've created a buy and hold security potentially in a UCITS fund for people who want to get long European investment grade credit. But now by making it big enough and trading it on exchange and having creation redemption baskets that are known to the street, you've actually created a liquidity tool that allows people to exchange cash for a basket of securities, right? Deliver a basket of securities, receive back cash, move back and forth between optimized baskets and securities and trade it on a tight bid offer. Now IEAC starts to look a bit like a CDS contract in the IG space.
This is what I wanted to say. The whole concept of the in-kind transaction has basically generated the fact that anyone, rather than inflow, I sell main and then I invest. Now it's the opposite. I buy the ETF and then I sort it out because I can trade in kind, and in general it is much more efficient because I don't have a basis risk, which I don't want. I'm not looking for that. And so this is, and I remember in 2016 is the first time the BlackRock actually came in our office and started to make a big push for hedge fund to start to trade actively on the long and the short side of the ETF. And we didn't know what an ETF was at the time.
It's interesting that they did that in 2016. So I was one of the founding members of Source, which is now Invesco's ETF business, set up in 2008, 2009, first a joint venture between Morgan Stanley and Goldman Sachs, then JP Morgan, Merrill Lynch and Nomura coming together, basically banks wanting to be in the ETF space, but recognizing that they needed an arm's length asset management entity to run those products, because Lixor and Deutsche were running both the vehicle and the derivatives, and that post-crisis was an issue for people because they were getting sort of SocGen in two different ways and Deutsche in two different ways. In the equity space, you can do creations and redemptions seamlessly, and you can do create to lend if you use derivatives, and you can basically draw up and draw down the size of the ETF, no problem. Fixed income, it's a little bit more difficult. There are more transaction costs. But the nice thing about a fixed income ETF is it's almost like somebody lending you balance sheet, right? Because as a fund, someone else has put in the cash that goes and buys and holds the instruments for you. So you don't have to worry about the funding costs of holding the instruments. And now you can kind of look at what could my relationship to this entity be, right? I can buy units and hold them just as a form of investment, and I can maybe take an accumulating or a distributing share class in order to get yield from that instrument. Or as a trader, I can look at it as, no, that's actually like a transparent bank balance sheet for me to trade against. And this is the thing that is out there, but hasn't fully been digested by people as to quite what it looks like if you stand back from it. And when BlackRock was talking in 2016, oh yes, we can solve problems for you by you can create, you can redeem, you can borrow. If you borrow and you can short efficiently. That was interesting and true about equity exposure, aspirational about fixed income exposure.
Indeed. I guess the next challenge is to get more provider like you into the repo market actively, because we need that. We need to be able to lend the shares, to borrow the share, to be actively utilizing more. I think that would be the challenge for anyone that is on the ETF space to get similar.
And look, even something as big as IEAC, the borrow cost is pretty significant. It's like 1.5-2%, right? So it's not like an equity ETF, which might only cost you tens of basis points to borrow it.
Which on our side generates opportunities because you can lend it, especially as cheap funding, if you look at that.
It's an opportunity for the lender, a cost for the borrower.
Indeed.
Obviously, you set an equilibrium between those two demands. I think what we've seen is that there's a certain amount of lending activity, but not an enormous amount, and therefore we probably haven't got that balance right yet. But when we look at basis trading, right, which is the idea that if you look at CDS pricing and you look at cash, that the two things are not necessarily in equilibrium for where things trade on a spread basis. And people use things like IEAC to express views on basis. We've tried different things to create more efficient basis tools, but ultimately you can technically build a better basis product, but until it's very large and trades a lot, it doesn't deliver the form of liquidity and ubiquity that people want. If you're a trader, you want 10, 20, 30 institutions to be ready to trade with you all at the same level. You don't want to have, I can get a special deal from this guy and that makes it make sense, but everybody else is trading at a different level. You want a nice flat playing field.
Absolutely. So I think, what is the next challenge for Tabula? What is the next products in the pipeline? ESG still the focus, or what is the next steps for the company?
So I think Paris aligned is always going to be an opportunity. The interesting thing about what's been going on in the environmental space is the constant evolution of product, and there are different aspects of the evolution. So one is data. What data do you have that allows you to build the indices, to build these differentiated indices and make them select the right issuers, the right securities, et cetera? That's constantly evolving. And you go from 4 years ago, you'd go and try and get data, and you get data on hundreds of companies. Today, thousands, hopefully soon tens of thousands. So that's one thing that's developing. The second is regulation around the actual products themselves. And exactly how you do it and how the central bank that you interact with, what they require in terms of building and disclosing. The third is everything around the labeling of products. And that's constantly developing, and who controls those labels. And this is when you start to realize how fragmented Europe is. Because theoretically, people come from the States and they arrive in Europe and they think, oh, great, euro, great. All these countries use one currency. You have UCITS, they all use the same technology. Couple of exchanges, most of the liquidities on the LSE and Xetra and a few other places. Great, we got just a few venues. But the reality is, as soon as you start poking into it, you realize that every different country is taking a slightly different approach to how you disclose. So Switzerland has a different approach from France, from the UK, from Sweden. So I think that the evolution of product in the environmental social space will be around the interaction between these three things: the data, the legal structures, and the disclosure. I think the opportunity for us is now that we have a couple hundred institutional investors who are already buying our products, and we're now in a two-way dialogue with them. It's about engaging them to drive the next product that we're going to launch. So we're always developing new products, but I'm not going to launch a product unless I'm absolutely certain that it's relevant to a reasonable number of institutions. And the way you find that out is by constantly putting sort of straw man products in front of people and saying, so what do you think? Is this exposure interesting? Is this way of solving the problem interesting? It's going to look like this. It's going to trade like that. The underlying trade on this bid offer. Therefore, the ETF will trade like this. Would you do it? Right? And so we've kind of gotten to, I always look at this, I describe it as a Boy Scout in the woods. If they've got a sales force and they've got products, they've got kindling and they've got logs, right? And you've got to get the two together to create a fire that actually has some heat to it and will then sustain itself regardless of what's happening in the surrounding environment. I think we've gotten there by having a couple hundred institutional investors and a dozen products. That gives us that sort of two-way. We can gather assets in the existing funds, we can launch new products, and then we'll be driven by where demand is. In the fixed income space, I think there are lots of interesting exposures. Outside of the fixed income space, I think there's some things to do in commodities where the existing products are interesting but have not changed in a very long time. And I think in equities, there are value propositions that offer more interesting exposure to certain themes than just selecting the next sort of hot theme topic. I think it's not just about going and saying, oh yeah, I believe people are going to be putting their money into nursing homes. Now I'm going to do a nursing home product. It's more like saying that people buy this sector, but there's a smarter way of delivering this sector, whether it be insurance or high yield or something else.
Absolutely. I mean, I guess the main challenge is the timing to launch that product before the problem that you're trying to solve is actually auto-solved.
Well, that's the one thing you can do as a small provider is the time from idea to on the shelf can be much shorter. So when I talk to friends who are at large institutions, that cycle is, 12, 18, 24 months, right? For us, it's 3.
Which is amazing.
So that's something that you can do when you're a bit more artisanal. It's something you can do when you're just a group of people who are all interacting and encouraging each other and working together and feel the importance of delivering quickly to clients. It's not that, oh, that salesperson told me he got this lead order and that's nice, but who cares? No, they see the client come into the office. They hear the feedback from the person who's talking to them. They get the idea of what this thing should look like that would be compelling. They are involved in developing it. They hear the feedback from the Central Bank of Ireland. They're then engaged in the process of launching the product, seeding the product, getting it on exchange. And everybody's part of that in some way, shape, or form. It's also, as an employee of a smaller company, you have much more of an idea of the front to back of financial services. I was having a conversation on Monday with one of the UK MP who's focused on financial services, and we were talking about the bad job that financial services has done in pitching itself to people because nobody understands it. Right? Because everybody does a very specialized job, and when they go to a drinks party, they describe the little thing that they do, and they bore the hell out of the person that they're talking 100%. To. Right? Because they talk about, I do repo and I extract, extra basis point, and I made, X last year, and they try to impress people with their new car, right? It gives them this sense of there's a bunch of money being made, it's totally irrelevant to me, and I don't understand it. If, on the other hand, people work in organizations where they can see the front to back and they can talk about the so what of why we're building these things, what changes it making to people's investment approaches, how are they making more money by using this versus something else, all of a sudden now it really means something. And they can get more engaged. So in a small company, it means that they can see why we launched this thing and how quickly it happens and how, if it happens faster, we actually raise the assets and they feel part of it. But they also understand as an asset manager, the complexity of, coming up with an idea, wrapping it into a fund, managing a fund, trading a fund, getting it out in front of hundreds of investors.
That's interesting. Well, I think our time is up, but thank you very much for taking the time to come here.
Pleasure.
And speak with us, and I hope to see you again soon here at the podcast.
Definitely. Love to.